Well, greetings, good morning, Tony Virtue speaking, and a better month. Market now flirting with 6,000 in Australia. I think a combination of them dropping interest rates early in February, which was a little bit surprising. As you can see, they didn't do that earlier in the week, which so sort of mixed messages there, but a combination of that. I thought the interim reporting season in general was pretty good. Interestingly, much more stock movement based on the individual stock rather than, if I can say, wider sort of global trends. So some stock moving 5 or 10% on their earnings, but in general not bad numbers. The dividend payout ratio now up to 65% of profits. So really a trend in Australia now for companies to be distributing as much as they can in dividends and franking credits, and increasingly clients holding stock for the dividends rather than necessarily for capital growth. I think that trend's going to continue for some time, and the reality now is that with interest rates so low, very, very difficult to get a fair return, if I can say, on cash rates, and all our old sort of calculations based on risk profiling is looking a bit antiquated at the moment, as the reality is that interest rates are much, much lower than how we kind of plan to organise those things. Internationally, again, all-time highs, particularly in the UK has done well. The US, very, very low rates. The Greeks have finally came to terms with the rest of the EEC, and I think that was pretty much predicted, that at the end of the day they're all in this together. In the same way that in Australia we would have a different interest rate policy for Sydney CBD than we would for, say, Tasmania. Same in Europe, you would do something very, very different for the Germans as opposed to the Greeks, but they're all in it together. They all benefit from a lower euro, which means their exports are more attractive, makes it easier for them to deal with each other. So that's the way it is, and I would think that will continue. Just one word of caution there: we have had a good run in Australia. Typically now the markets will either sidetrack or go back a little bit, so no room for euphoria. The earnings now looking at about 18 times, which is higher than historical averages, so the market isn't cheap, so just be mindful of that. Government yesterday came out with their intergenerational report. We covered that in the newsletter, and as you'd expect, we're all going to live a lot longer, and a few of us are going to be working, and that's going to put a lot of pressure on the budget. It's going to put pressure on healthcare, pressure on pensions, retirement. I think if I could take a message out of it, it is very much that self-reliance is the go. We need to do what we can to build up the amount of money we have, whether it's in super, whether it's in property, whether it's in shares, where we can generate an income to live off however long we live. And they tell me now, someone born today, the mean age they will live to is 95, the mean. So for 40,000 people now who are alive now, they'd expect to live past 100, and here's the tip: I hope to live past 100, and I hope to be working in some capacity up to 100. So that's a scary thought for all of you, but that's enough for this week, and greetings to you all, and look forward to seeing you soon. Take care, bye bye.